Welcome back, everyone, to Living Your Greatness. And today I am joined once again with Peter Grandich. So, Pete, it's a pleasure to have you back on the show.
Good to be back with you.
Yeah, absolutely, Pete. Pete, we were just talking before this call, and I was kind of saying how, a big thing I think that is really important in this investing world is understanding how to make decisions, especially because of a lot of the things that you've spoken about of how the investing game has changed so much. So the focus of this conversation is going to be more about how do we provide investors, with investing tools as well as mental models and frameworks, inspired by someone like Charlie Munger to make better decisions. So the first question, Pete, that I want to ask you, because we're going to be applying this obviously to the natural resource space, is, as a natural resource investor, how do you apply the margin of safety concept to your investment decisions? And how has it helped you avoid costly mistakes?
Well, I took a lot of costly mistakes to finally come up with good rules. I was telling you that sometimes you listen to these folks that are in the junior resource market, you never thought they lost on anything. But I certainly have. And I come up with what I think are two critical rules, certainly for me and anybody that wants to listen to me. And that first one is failure is the norm in the junior resource market. For every 10 companies, and they're all honest, not talking about anybody being dishonest. They're all hoping to find some sort of metal or metals. But at the end of the day, only one or two will find, develop, sell, or bring into production a mine. So the first thing is to understand that you can't beat yourself up if it's not working because some of them are just not going to work no matter how good they look when you originally invested them. But the second rule is far more important. And it took a real bad beating last year to finally cement it for myself and hopefully others that want to listen. Not only do you have to be financially prepared to lose part of all your capital, but you have to be mentally prepared. And once you are, and you've identified a certain amount of capital, like going to a casino, we lose it on the tables or a slot machine, and we had a good time when we leave. If you do that with junior resource stocks, both one and two, then the opportunity that that market gives of 10, 20, 30 times returns on certain ones can compensate the losses. But also, if you have a not so great streak, you're not hurting your financial and mental well-being. And by the way, when you lose financially, you're also going to hurt mentally. Very few people can lose a lot of money and just make don't matter. It impacts you, even when you're supposed to be an expert or something. So I think those are two really important rules. And in any type of investing, and I learned this, I spent 13 years with the New York Giants doing Bible study in chapel, but I got to go the night before to do it. And that's when they would have their meetings and then the coach would talk. And they literally, when you hear they say that they have a game plan, they really, really do. It starts on a Monday, and by Saturday night, they present it to the players. And many times they have a plan B as well. A lot of investors don't even have plan A. I can just tell you this from what I hear from retirees here down in the States who were down 25% last year. They had no plan B, nor did their advisor give them a plan B. And they're living on the worst investment strategy in the world, hope. It's a wonderful spiritual strategy, but the worst investment strategy. You need a lot more than just hoping something works out to be successful.
Totally. And I definitely think there are a lot of investors sometimes that maybe don't do enough homework or due diligence and are sometimes more emotional and hopeful than actually maybe educational. And that's why I've brought in you on, is to have this discussion that's going to be a lot more educational. And, when I'm listening to your second rule, about, being willing, to lose money, because especially in this sector, it can be very volatile or risky, or you kind of use like the terminology like casino, right? There is one question that I want to ask related to that is, how do you differentiate between investing and speculating? And how do you balance the two for your approach in the mining sector? Because there is a way to do both.
Juniors are all speculating / gambling. The word speculating was used so you don't have to call it what it really is, gambling. Think of gambling and think of speculating in the same way. I would not say juniors are investing. Investing is usually on the basis of you have a fairly sense of good, secure principle, and you're looking for some type of return. There's no such thing as safe principal in 20 and 30-cent stocks. It's also, I think, not useful to use technical analysis for 20 and 30-cent stocks because they're not trading on any technicals. They're purely fundamental factors that are moving a junior. So I think it's really, really important that we understand that we need ground rules and we can't do what most people do. Most people, whether it's financial planning or just juniors, have no plan. They'll buy the stock, but they have no plan based on the different things that can happen with it. And emotion, it's been demonstrated for decades, is when you're highly emotional, good decisions are not normally made. And it doesn't matter whether they're personal, business, love, or in speculating and investing. So it's very important to have a plan B and also what happens if certain things don't work out.
Absolutely. And you know what? I'm really happy too, Pete, that you pinpointed in terms of, what is investing, what is speculation. I agree with you as well. When it comes to junior mining stocks, it's speculation, it's not investing. But there are ways that we obviously can in terms of, buying like the physical metal, right? There are safer kind of bets. But something that I want to tie to next is, when you're thinking of investing in the space, you also have to do your homework, right? And I know there's some thought leaders in the space, like Michael Gentile that you're a big fan of. And, there's Eric Sprott and there's other big names that probably people that are tuning in right now who already know the space probably know of them. And if you don't, well, now you do. But how do you define, Pete, for you and expand your circle of competence as an investor in the space? And what are some strategies that you do, to stay educated so you could keep knowing like the sector better to at least make decisions that are maybe a little less risky than if you went in blindsided?
Well, this is not just for this industry, what I'm about to say, it's just about for anything. If you do enough promotion, if you hire enough advertisers, if you sell yourself in a bunch of different ways, you could be viewed as an expert and actually do very poorly on the underlying thing of what you are actually called to do. Okay. So maybe one of the first things you don't want to do is just because you've seen somebody in their names and some people saying stuff, always it's better for personal experience. And if not, somebody that you can trust can recommend. Like if you're looking at your house to be fixed, I think it'd be much better if you can go to a good friend who had the experience and say, listen, Joe is a real good guy versus going on the web now. I was going to say the yellow pages. That's how long far I go back and hit your finger and just pick somebody. The same is getting advice here. This because the business failure is the norm, I would be very suspect if whoever you are listening to never seems to talk about losing or things can go wrong. They always seem to be presenting the best case scenario. And I actually think that's a place of caution in an industry, like I said, where failure is the norm. And so when I even look at management or talk to management, and you find out that, this isn't the first rodeo they've been to, some of them have worked for 6, 7 juniors and 6 didn't work out. When they openly express that, I have more confidence in them than people that say they're in the business 30 years and yet there's no real record because a lot of the companies they work for went down. So, and let me add one little thing. In juniors, management is absolutely critical. It's it's by far the most important single factor because it's an industry where you're constantly raising money, you're constantly trying to bring awareness to your situation. They have to be very talented at both of those things because mining isn't like technology where every 6 months something radically totally changes. You basically mine kind of the same way now as you did 5 or 10 years ago. So those skills, as I said, for those areas are more important than that they worked on a mine. I mean, you have to be a good raiser of money because dilution is what kills you in this game. And that's one of the problems now where the market's at. Because it's been beaten down so much despite the rises in metal prices, and so many shares are outstanding in some issues, they would almost, in a sense, not be able to raise money because whoever's putting the money in the dilution is too much. So one of the things I'll just tell you is there's probably going to be some significant mergers on the lower end of the totem pole, and it's going to be out of necessity.
Absolutely. Now, Pete, I want to pinpoint actually and go back to, you've said it a couple of times in this interview. You said the failure is like the new norm, right? And how crucial that is of understanding that it's extremely common. And something that I want to ask you is, I don't hear you get asked this often, but what is a failure, that you're comfortable with speaking about that really taught you a hard lesson in this space? And if you don't mind, if you could just talk about it for the benefit of my listeners.
Sure. I mean, let's take last year. That's the ultimate one. Here I was, 38 years in the business. I just said in 2021, get out of stocks completely, get out of bonds completely, own gold, better off, get out. The year before that, get out of crypto. I mean, I was hitting them out of the park with my forecasting, but where a lot of my personal money went was into juniors because I felt I knew something. And the end result was very substantial losses that led to a lot of mental anguish, which led to depression and serious depression. And I find it very, very disheartening. Again, I'm going to hop on it, that there's people in this industry where this business is very tough to be successful. And I've known them for years or decades. Even though I was out for 10, I still watched them and all. And I never hear them talk. Even when I was an MC at a conference in Vancouver for 20-something years, I introduced the same guys there and at other conferences. And I have to sit there because I'm the MC. I have to listen to them. And they never, ever once shared something or even remotely like I just shared with you. But trust me, it happens to everybody. So I think that's a big warning signal, especially in this business, when someone doesn't own up to, I haven't always been successful, because no one is in this business. Failure, like I said, is the norm.
Absolutely. And I think a good example of that, and he's also been honest about it on a couple of interviews, and I know you really admire him as well as myself. But even Michael Gentile had said on an interview, I think it was maybe 2 or 3 months back, hey, I was wrong about like the timing with some of these companies, et cetera, or plans aren't happening as quickly as I had thought. But the reason why I'm bringing that up is I'm curious to ask you now, this is related to our last kind of question, is how do you navigate the volatility in the mining industry, and what are strategies that you do to capitalize on opportunities during different stages of the commodities cycle? Right? Because there are ways as well to look at that.
So Michael actually said failure is the norm without actually using those words, because what he just said in an interview with me is, you buy a bunch of them, several of them are not going to work out, but the ones that go up 20 or 30 times make up for more than the ones were down. So he basically said it without saying it, if you understood where he was coming from. I think the thing that we have to understand here is that it's very hard to get in depth unless you have an understanding of it or trust somebody. In other words, firms have investor relations. Okay. I have a blog. Okay. And it's sponsored. Okay. Now, my understanding with them is I'm free to say what I say, and I never tell people you have to buy it. This allows me for everybody to see it and not have to subscribe. You don't want to buy the stock, that's okay. But it's very hard when you hear somebody talking about grams and certain types of sentiment and all, and you can sound very, very smart if the person doesn't really know anything about what you're talking about. So I think one of the things you have to identify is, and this is the negative of what happened over the last 10, 20 years, because as I used in a video I made earlier for my own viewers, 10, 20, 30 years ago, there were hundreds of financial advisors that built a book around resources, and they were experts. That's what they did. That's what they lived and breathed. And their clients counted on them to figure out which companies to own and all. That's gone. So the end user is still there. That investor or speculator is still there. But the buffer that used to help them decide what to do is gone. Now, some of it has morphed to websites and YouTube channels and people, saying that they're an expert or something. But again, track record, willingness to talk about losses as well as winnings. These are all critical things now, no matter how you're actually hearing about it. And it's very tough in this business. Understand this: junior resource market, the sector is, you can't even, maybe I should put the two fingers together. That's how small it is compared to the rest of the market. It's very few people following it. Very few brokerage firms do research on the small ones unless they raised money for them or they're looking to raise money for them. So it's very hard for someone who doesn't know anything to come in here and just, spend money across the board. That's why ETFs became a great thing, where you could get exposure to all of these things. And there are a handful of small mutual funds that invest in the juniors as well. But Michael Gentile has a much bigger advantage, or Eric Sprott and others, not just because they have the capital and the knowledge, but they also have connections and people want them in. So they're more open. They can learn more about a situation, quite frankly, than you could reading a website, reading what they have on their website. So this is why it's a lot tough. And we are going through, as I just put up before we did this interview, a capitulation period in the juniors. It sounds crazy with gold just a few days ago at 2,000 that there could be a capitulation, but really people are just throwing in the towel. You can see it all over the internet. I can see it by the emails I get and how other people talking at a time when I don't think they've ever been cheaper as themselves, and also to the metal prices that they're looking for.
Absolutely. No, for sure. And you know what? I'm happy that you spoke again about some of those leaders. It kind of made me think of, I was at a conference about a month ago, it was Jay Martin's conference. And a big theme that was happening when I was there was a lot of leaders like Frank Giestra, who were talking about, playing defense, and that was a big, big theme at the conference. And the reason why I'm bringing this up is, right now, even though the sector is unloved, people are putting in like the towel, like you said. A question I have is, who are some other leaders that we haven't already discussed about that you follow their work closely to help you make better investment decisions? Because it's important to also catch our blind spots as well.
Well, you named one, Frankie Giestra. Frank is a man that has been successful in multiple industries at multiple times. And when someone can do that, you need to listen to them. He's not into every Tom, Dick, and Harry situation. He's extremely selective, and he's very bright. He understands what macro is all about. Go back a couple of years ago, he did the great debate with the penny stock hustler of the 21st century, Michael Saylor, and he everything Frank said turned out right. And so that's a person there that I think is worth listening to. I think also you need to, like I said, understand and go back to what we said before, that when you're speculating and gambling, are the people you're listening to in the same position as you are? See, you mentioned some people and they're worth tens and hundreds of millions. That one thing can blow up, doesn't really change their life. But some people get caught up in it and put a lot of their personal money in, and it does impact them for the negative. So remember, you're not playing at the same level they're at. And so even though they may be enthusiastic, understand that if it doesn't work out for them, life doesn't change much for them. But you certainly don't want to put something in that makes your life change for the worse if it doesn't work out.
Absolutely. No, I couldn't agree more with you there, Pete. And Pete, what do you think separates a good investor from a great investor? We've talked about failures. We've talked about mental models to help people make better decisions. But how can someone become a great investor?
The first rule is, or there's a couple of them. The first is the person that's going to end up doing better is not that they made more money on the upside, but they prevented losing a lot of money on the downside. So that's the first thing. The second golden rule is the ultimate crime in investing is not being wrong. You're going to be wrong. It's staying wrong. That's where people get hurt. And I said earlier that hope is a bad strategy. You'll hear this. Hey, Mr. Grandich, you know such ABC company? Yeah. Well, I bought it at 10, it's at 5. Uh, what do you think of it? I said, you're going to buy more? No, I'm just hoping it goes back to 10. Well, first of all, I tell them about the hope strategy is not a good strategy. But I said, you do realize, even though you say you're down 50%, you now need 100% gain to get back to where you were. And one of the problems that investors have is, and we call it deer in the headlights and all, they can't let go when they're losing. They can't, they just can't bring themselves. In fact, they'll sell winners to average down on the loser versus sell the losers and put it into a couple of the winners. And you have to understand that losing is a part of investing, and it's a numbers game, and it's pride that gets in the way. Hubris, something that I had in the days when everybody was calling me the Wall Street whiz kid. You know, I was a legend in my own mind, and hubris can really get you into problems. And some financial advisors are very hubris, and that can hurt you because they'll go through a wall not to admit defeat, and that wall unfortunately falls on you.
All right, great points there, Pete. Well, I appreciate that. I'm sure my listeners do as well. And the last question, Pete, that I want to ask you, before we sign off is, who is a future guest, someone that you personally know that you would like to see interviewed on the show? Last time you had mentioned Michael Gentile, and that was a great recommendation. We made it happen. Who would you like to see this time?
Well, you mentioned his name, and I don't know if he's been on your show, but I've been very, very impressed with Jay Martin, who runs that Vancouver show and now has a great newsletter out. His dad is who I started with and was around for 20 something years when he started the conferences out there. Jay has taken both that business to another level, and his acuteness to understand a variety of things, not just centered in one area, be a tremendous interviewer, but also expresses himself in the most humble way with depth of knowledge. So I don't know if you ever interviewed him. You said you were out at the conference, but he's been one of the more people that have impressed me here. And then, of course, Daniel Camboni, she's always been my one of my favorites. And then there's a lady that works for Bloomberg that I've written a lot about in the last several days on my own Twitter page, Lisa Abramowitz. I think she's the best financial journalist I ever knew in 40 years. I don't know if she'll come on your show, but she does have a Twitter page, and you can try reaching out to her.
Absolutely, Pete. Well, I appreciate all those recommendations. I did want to let you know that both Danielle and Jay have been on the show. And in fact,
okay,
I want to give a shout out to both of them because Jay was my first podcast interview, like first guest I had ever had. And he was so generous with his time. And that's about almost 2 years ago today. So Living Your Greatness is almost hitting its 2-year anniversary. And I want to give him a shout out because he helped make that first episode happen. And then Daniela was halfway through. So she was another one that was just such a pleasure to chat with. So I could definitely consider bringing them back on, just like what I've done with you, and come up with another insightful interview.
That's good.
And so Pete, last off, I just want to thank you, for making the time to come back on the show. I've really enjoyed, following your work in the last, I would say 4 years, and especially in the last almost 2 years now, forming a relationship with you and also getting to know you more. I think you're a great person, and I can't wait to keep this relationship going.
Well, thanks be to God, and may you be blessed and continue doing this. It's very good that you're seeking to take an educational route versus a touting route. So I hope people benefit not just from this show, but all the ones you do.
Absolutely. Thanks so much, Pete.
God bless.